Hi everybody, welcome to another update on the stock screener. Today we're going to talk about the net present value timeline and talk about the importance of this concept. Let's say we have company number one, and this company has cash flow coming in every year until it reaches its enterprise value of 70 million. And then the company stops producing, and that's it. You have your 70 million enterprise value, and you get your money back, and you can put that in the bank to get 10% interest on that, and that's it. So that's company one. Now you have company two, and it looks different. But it has the same enterprise value and also the same net present value. Net present value is 70 million. Here as well, 70 million. So everything is the same. Enterprise value is 70 million and NPV is 70 million. But the timeline is different. So for company two, they won't have any cash flows up until the end of the project. And just at the end of the year of the project, you will get all your money back, $150 million. Here you only get, if you add this up, $90 million in the beginning. So if you discount everything, you get the same NPV of 70 million discounted 10%, right? So both projects are, in theory, the same value because they all end with the same NPV at the end of the project. But there's a huge difference between these two companies. And I will talk about that on this slide. So the first company has earlier cash flows. And that's always better than having late cash flows. Do you want your money now or in 10 years? Of course, I want it right now because the market is uncertain. This one has market certainty. You know exactly what will happen in the next 2 years. Here, you need to wait 10 years to get your money back, and you will not know how the market will be in 10 years. So this is based on market promises, while this has market certainty. You are promised to get your money back in 10 years. But here you get it right now. This one also has more flexibility because with that money you can do a lot of things. You can put it in the bank, you can put it in the ground, you can buy projects, a lot of flexibility. Here you have bought a company and it's not producing any cash flows, so you have no flexibility. You're just sitting on that asset that you bought and it's not providing any money for several years. So no flexibility here. You don't have cash, you can't do anything. This company has liquidity. So you have your cash and you can do things with that. This one has no liquidity, no cash, which leads to dilution risk. A company that doesn't produce anything will need to dilute shareholders at some point because they have costs associated with that company. And here you are cashed up, you get cash flow in, so there's less dilution risk for company one. So which one will you buy? I would choose company 1, of course, instead of company 2, even though they both have the same enterprise value and the same net present value of the project. So let's look at a real life example. We have 2 copper companies, and these are real companies. First one is Trigon Metals, which I own. And the next one is Oroco, which I don't own. And you can see why. This company has earlier cash flows. So you get your money back somewhere between 2025, 2026, where they will have huge production increases and positive cash flows. And this company has late cash flows. So you need to wait probably 10 years to get your money back. They could go in production somewhere in 2030 or something like that, because they are still in feasibility study stage. It'll take 2 years, then maybe a year of financing, permitting, and then a few years of construction. So a lot of years until they can start production. And even when they start production, you have negative cash flows first, and then you are starting to pay your debt back until you reach your enterprise value. And then there's upside, of course. Huge upside, 1 billion NPV, depending on the copper price, of course, and other market conditions, grades, etc. But you need to wait at least 10 years to get your money back for this company. So this is based on market promises that they will get in production. This one is based on market certainty. They are already producing from the open pit. They are already dewatering their underground, already making cash flow for next year, increasing production, and then paying off the debt, etc. Actually, they don't have any debt, so they don't even need to pay off debt, and the cash flows will come in. What's the upside? The upside is 50 million enterprise value going to 500 million. That's a 10x. Here, 100 million going to 1 billion is also a 10x. So both companies, as you can see here, have the same upside, theoretically. But this one goes into production much faster than this project. This one has more flexibility, of course. They get their money faster and they can do whatever they want with that money. They can keep on growing production, or they can buy other properties with that, or they can put it just in the bank to get interest on that. So there is a lot of flexibility here. This one has less flexibility because they don't have any cash. So this is liquid. Cash flow is coming in the next few years. This one is illiquid because they don't have any cash flows. This one is cashed up, fully financed to go into production next year for the underground. This one is not cashed up. Okay, they have dilution risk. They need to drill a lot of holes, do feasibility studies, financing. So there is huge dilution risk with this company in the next 7 years. So that's the difference between company 1 and company 2. So if I had to choose, I would, of course, take this company. So that's the importance of looking at the NPV timeline. Do not stare blindly on the net present value of a company. You need to visualize how the cash flows are coming in. Do they come in earlier or do they come in at the end? And that was the video. I'll see you in the next one. Bye.